Coal of Africa's full-year revenue rose 166% to $261.4 million. And joining us in studio to unpack the results is the company's CEO, John Wallington. Thanks so much, John, for joining us this afternoon. Well, just looking at the numbers, hardly surprising what's come through here with you being a coal player and where we know demand for coal has seen prices rise phenomenally. And so you're leveraging off both those characteristics of the current market right now. What's your assessment of the market you're in?
The coal market itself. Well, like all commodities at the moment, with the uncertain economic climate we're in, we're not sure where commodities are going. But certainly China and India will dominate where coking and thermal coal go in the future. But both the fundamentals of coal look pretty good at the moment.
It's all about production and creating the volume to fully leverage off the demand that is out there, though. And, cementing what the results today have done has cemented your evolving status from an explorer and development stage company now to an actual producer and supplier. So run us through that evolution we're seeing.
Yeah, we're not there yet. I think we've had almost, as we all know, extremely challenging year at coal, and it was a pure exploration play not too long ago, and it's a big transition to make, to get it into a production and development company that has the capacity to actually do that properly. So we've still got some work to do to get there, but we've made a very good start, and we've transformed substantially in the last 12 months.
Where we're looking at a production ramp-up, one would assume that it spells a ramp-up in costs as well. So just what capital investment are we looking at here? Because that's a factor to consider when evaluating ROI.
No, the biggest capital that we'll be looking for is the Mikado project, and we're hoping to get the final go-ahead sometime in the middle of next year. Before that, really, it's possibly the acquisition to put to bed the acquisition of the Rio Tinto Chipudi assets, and to get Velo going.
How much a part of your strategy is that, kind of acquisitive strategy that you've certainly been implementing to an extent where you're consolidating with mines close to your current assets?
Well, coal, the two thermal coal assets, we need to try and do something to make them more competitive. So that's the first thing, to bring those assets up to date. But the coke and coal assets in Limpopo are particularly attractive because we have large tenements there, they're contiguous, and they have scale and optionality. So that's where the near-term focus is going to be.
And especially after we had, the lifting of that regulatory hold that was imposed by the South African Department of Environmental Affairs, just what kind of a timeline are you looking at before we've got things fully on track in that regard?
Well, hopefully only a couple of weeks left. One can never tell. It's a long bureaucratic process, and it's procedural, and it's legal, so all these things take time. But I think we're nearly there. We've made great progress. I'm very pleased with the announcement that we had, the agreement that we've had with the Sand Parks and the Department of Environment, and hopefully that becomes a way of mining collaborating with its stakeholders in the future. In
terms of the market you're catering to, what are we looking at domestically and then offshore? What's the split there?
For Coal of Africa? Well, in the next year we need to now bed down some of the cleanup that we've done. We need to get Velo going, and we need to get the Mikado projects approved and starting to build. Those are the two big ones. We continue to ramp up our exploration to see to prioritise our other projects that we've got. And then on the existing thermal coal assets is to continue to improve. We've restructured at both, and we now need to continue to improve our efficiencies at both.
But in terms of taking that product to market, let's look at your export capacity right now, because we know when it comes to exports, a big challenge has been infrastructure bottlenecks.
Yes.
That there isn't that support infrastructure to support the business, beyond South Africa's borders. How are you leveraging off what is available, and what are you hoping to see in terms of an evolution of support infrastructure?
The plus is that our allocation at Maputo has gone from 1 to 3 million tonnes per annum, and that's great. And since the end of March, when the phase 3 was completed at the Matola port, I must say Transnet's freight rail have increased their performance substantially. So they've gone from the 1 million tonne per annum run rate, we're already over the 2 million, and by the end of the year we should be at 3. So that's the first 3 million tonnes, and Coal of Africa have have the option for phase 4. Which will be potentially another 10 or 20. We certainly won't be the only players there, but we have first option to access that port. Yeah. And those discussions with Transnet Freight Rail will be the same. The one challenge for us with Transnet, with the rail costs to Maputo, is that the costs our infrastructure costs, logistics costs are much higher than the Richards Bay line, and that needs to be something that needs to be resolved over the next few years.
Well, certainly progress that we'll be keeping an eye on. John, thanks so much for having joined us this afternoon.
It's a pleasure.
Of course, John Wallington is CEO of Coal of Africa.